Good morning, ladies and gentlemen. It's a pleasure to welcome you to the Q3 results conference of Photon Energy. Today I'm very happy to welcome next to me our new CFO, Stanislav Zeman.
Good morning.
And we will be running you through the presentation. Those of you who have been with us for a while know the structure. So I will run you through the business results for the third quarter. Stanislav will then run you through the financial results for the third quarter and the first 9 months of the year. And at the end, we will have, as usual, space for your questions, which we will try to answer as well as possible. So we'll start with electricity generation. In our IPP portfolio, in terms of size, in the third quarter, there was no change in installed capacity. Since the beginning of the year or year on year, we have had a reduction of 6.2 megawatt peak, which is mainly driven by the disposal of our Australian power plants in the fourth quarter of last year, which had a combined installed capacity of 14.5 megawatt peak. And since then, we have commissioned 3.2 megawatt peak in Romania. That was also in the fourth quarter last year. And in the first quarter of this year, we added 3 power plants with a total installed capacity of 5.1 megawatt peak. So in total, a reduction of 6.2 megawatts peak. In terms of electricity generation, we have seen a decline of 9.4% to just shy of 50 district gigawatt hours for the third quarter. And of course, that is mainly driven by, well, to some extent, driven by the reduction in installed capacity, but also by the non-generation of some of our Romanian assets, which are shut down for various regulatory reasons. And in the third quarter, they had a total capacity of 27.2 megawatts. So a significant part of our portfolio. So in the light of this, the decline of 9.4% is actually a good result. Of course, overall not satisfactory because we want these assets to generate, but it has at least to some extent been compensated by good generation results, mainly in Hungary. Speaking of the situation in Romania, so one of the power plants that was switched off, Savulesti, received a license in October. Aiud and Teuș, we expect to receive the license before the end of the year. So specifically, we hope that by the beginning of December. And for the last remaining 2 power plants, Făget 3 and Săhăteni, they are currently undergoing testing, and we expect them to receive the licenses in early Q1, so hopefully by the end of January, so that we step into next year with all or January will be a relatively weak month in terms of generation, so it will not be completely 100%, but essentially we hope that the availability of our Romanian assets to deliver to the Romanian grid will be very close to 100%, and that we will be in a situation where we'll have left these regulatory problems in Romania behind us, and all the power plants will be able to generate. And I think when we get to the financial results, you'll also see the impact of these this Romanian situation on our revenues, but also on our EBITDA. So in short, we expect that to be behind us as we enter into 2026. So just extending what I said before, the output decline was pretty much linked to our merchant portfolio because all these power plants that have been affected, but also the Australian power plants that we sold were all operating on the basis of merchant model. That means they were selling into the electricity market without any government support, but also not on the basis of a power purchase agreement. And as I mentioned before, what helped in the third quarter was the performance of our Hungarian assets, which were 17% above their generation forecasts, and the problem with underperformance came from Romania for the reasons we mentioned before. With the other countries, Czech Republic and Slovakia, performing more or less in line with forecasts in the third quarter. Looking at the prices we realized in the third quarter, we had a year-on-year decline of about 5%. And again, the main driver there has been the situation in Romania, where not only the volume was lower, but also those power plants that were producing but still had not received the license were impacted by a regulatory change that limited the revenues we were getting from Transelectrica. So just as a quick reminder, when we originally connected those power plants, or connected our first power plants, the PPA that we signed with Transelectrica in the period from commissioning and grid connection to receiving the license, we were paid the 90-day rolling average updated daily of the day-ahead market price in Romania. And in October last year, that changed into a scheme where our power plants are not paid on weekends, and that's also when we switched them off. And we're also not paid on public holidays. And during weekdays, when we produce and when we sell into the grid, we are subject to a maximum price of 80 euros. That means if the price is below, we get whatever that price is. And if prices are above 80 euros, typically in the morning and the evening hours, we're limited to 80 euros. So this regulatory change had an impact on the average price realized by the entire portfolio. In October, that means after the end of the third quarter, we have seen an increase compared to the number achieved in the third quarter. Now in the fourth quarter, and also the first quarter, we will be benefiting from higher prices. And once all our power plants have generation licenses, there will be no cap and of course full production. Looking at the revenues for the quarter from electricity generation, we achieved 7.8 million euros, which is a decline of 14% for the reasons just explained. And that represents a 14% decline compared to last year's level. I think that you'll also see that then in the financial results. So this is of course more than 1 million euros that is missing, not only in the revenue line, but also then at almost 1-to-1 at the EBITDA line, as of course these revenues or the lack of them flows through straight through the P&L. For the full year, at the end of the third quarter, we stood at 20.1 million for the full year, which represents a decline of 5.7%. So looking at EBITDA for the third quarter, we suffered a decline from 7.3 million achieved last year to 6.6%, which is 9.8%. And this effect we expect not to repeat next year, as all our power plants will have the generation license issued in Romania. When we look at engineering, and here we're looking at these numbers are based, as with all the other segments, are based on purely external revenues. We had a decline in the third quarter compared to the quarter last year to 1.4 million euros, and that is a reflection of, on one hand, the completion of the power plant that we built as an EPC contractor in New Zealand. So the majority of works, and therefore also invoicing, was completed already in the second quarter, and also delay in the start of construction of the 34 megawatt EPC project that we're doing in Romania, where construction will only start in the first quarter of next year. So a lot of revenues that we were originally expecting to book still this year, and of course the revenues start rolling in when construction starts. That is also delayed and therefore has not been recognized in the in the third quarter. Where we've also had so far a difficult year is in the C&I segment, where we're active, particularly in the Czech and Slovak markets here in Europe and the Australian market. And here we've had another difficult year in the Czech Republic. So this market has been behind our plans. However, we do see now a significant pickup in activity, and I think the main change in the type of projects that we're seeing is that essentially today almost all C&I projects include batteries. So projects where we only install rooftop behind the meter, and sometimes also ground mounted behind the meter installations is becoming a very small minority. And here we are actually quite satisfied with the pipeline development for 2026. So our expectation is that this segment will show very dynamic growth and of course can also improve the picture. Looking at EBITDA, again year on year, we have had the segment has slipped into a loss, and the main driver here, well, besides the lower revenues, has been cost overruns and also also delay penalties that we were subject to in relation to the project in New Zealand. And so we have been largely paying the price for building a project in a market that is at its early stage of development, and this has a significant part of this loss is so about 50% is attributable to these cost overruns and liquidated damages we had to pay to the customer, the contractual penalties for delayed connection. In the new energy segment, we've had a year-on-year strong quarter with external revenues actually growing 38% to 8.9 million euros, and that has happened despite the fact that the contracted volume from the auctions with PSE has been significantly lower. So we only had 1/3 of the megawatts contracted with PSE. However, we have been able to use the contracted capacity with our DSR clients in the additional auction, which was held in the second quarter and started as of July 1st, which has allowed us to cover a significant part of the gap in terms of revenues year on year from the Polish capacity market. The issue that we have had and that we refer to in our half-year presentation of delayed revenues from PSE in relation to this additional auction have been resolved in the meantime, and all the revenues that we were due to receive have been received from PSE. In terms of energy trading volumes, you can also see a very dynamic development year on year. We more than doubled the volume of electricity that we have traded in the markets, sold into the markets, and these markets are Poland, the Czech Republic, and Hungary, where we offtake electricity from, in some cases, our own PV power plants, but also from a growing number of external customers. And as you can also see, As a result, year-on-year, the EBITDA based on external revenues has improved very significantly from less than 200,000 a year ago to over 1.4 million euros. And we're also making strides in launching ancillary services. So we have completed our connection to the so-called LFC nodes, which are the communication channels with the transmission system operators, both in Poland and the Czech Republic. So we are working now on completing the last tasks, and soon we'll start with the work of certifying our first assets that we will want to trade in the ancillary services market in both countries. Operational maintenance has had another very, very strong quarter where we have been, and you can see that on a year-on-year comparison, but also through Q3 alone, we've also been able to add additional capacity. So on a year-on-year basis, you can see that we have increased the volume of contracted capacity to which we provide technical operational maintenance, asset management, but also cardio, which is a service targeted on the maintenance of inverters. We've been able to grow that by 34% to just shy of 1.2 gigawatt peak. And on the next graph, you can see how much of the capacity is active, which means where we are invoicing, and which are non-active. And that non-active part means that we have signed agreements, but we are still in the process of taking over or are waiting to take over those assets under our O&M or in some cases asset management. And so typically these contracts get signed somewhere between 1 and 3 to 4 months before commissioning of the power plants. But we have some assets or some power plants that have incurred longer delays than that. And so there we are essentially in the standby mode. But the important thing is these 319 megawatts are contracted and will start generating revenues once we take them over. What I can say is that this positive trend is also continuing in the fourth quarter. And looking at our pipeline, we see a lot of potential for further dynamic growth in next year and beyond. And what I would like to highlight is that when we talk about O&M and assets under management or asset management services, which we currently provide to customers in Hungary, this relates to PV at this point in time. But we now see the first large-scale utility scale batteries coming on grid. And this is also a very strong focus of our attention. So we are expanding our scope to also servicing batteries of all types. But of course, in terms of numbers and volume, utility scale batteries are much larger. And at this point, we expect to sign our first O&M and asset management agreement for a large-scale utility scale battery in one of the markets where we are active, which we then expect to open the door and put us on the map as a provider of these services. So it's essentially a completely new energy asset type, further increasing the potential for growth in our O&M segment. From a technical point of view, we have our own teams in all 5 markets where we operate. Of course, there's some training required, but we are perfectly capable of also servicing batteries, which in many aspects are simpler than PV plants. And in addition, what also helps us a lot is that so far in Hungary and Romania, but over time we may extend it to other countries, we are also certified to maintain high voltage equipment, very often for large batteries, large PV plants, substations, get built, and we can also service those. And that's one of the competitive advantage we have over some of our PV O&M competitors, that they don't have this certification. So we can essentially provide a full package to very large energy assets, whether they are PV or batteries. So in terms of external revenues, the growth year on year, it has been 7.7%, which is to some extent driven by the fact that in Q3 last year we had some one-off revenues that have boosted the 1 million revenue last year. So stripping that out, the growth would have been more dynamic. Talking about the EBITDA of the segment, it is very important looking at this to point out that these numbers are misleading to the extent that as we strip out the revenues that the O&M segment generates from providing O&M services to our own portfolio, but all the operating costs remain in these numbers. So another way of looking at it is that in the third quarter of 2025, 432,000 was the cost of maintaining our power plant portfolio in the entire region. The value of that is significant. So when we look at it only within the segment, leave the intragroup revenues in the P&L, this business line is actually profitable, and that profitability is also growing and will continue growing. The next segment is Photon Energy Technology, where we wholesale key components, which are mainly modules, inverters, and batteries. At this point in time, these batteries are mainly residential, but more and more also for C&I applications. So while residential is typically 10 to 20 kilowatt hours maximum, sometimes a little bit bigger, C&I, we're in the hundreds of kilowatt hours, and sometimes even below, even above 1 megawatt hour. And as you can see, year on year, we have, and here I'd like to just remind that as of October 1st last year, this business line is under new management. So we are comparing the Q3 results from last year under previous management with the results under new management. So in Q3, you can see that there's been a very significant increase in revenues by nearly 150%. As you can also see, that growth has been driven primarily by the volume of modules that we have distributed. So from a few megawatts, we reached almost 40 megawatts in the third quarter. So it's an almost tenfold increase. In the next couple of quarters, we do expect batteries to start playing a more significant role. And in terms of prices, because one thing is volume and prices here, we've seen a more or less stable situation in the third quarter. And now in the fourth quarter, we are seeing a little bit of a decline. And our understanding is that the module prices for next year may start edging up around the second quarter of next year. In terms of profitability, in the third quarter, we have booked a negative EBITDA of 200,000 euros. But it is important to point out that the vast majority of this is related to the final disposal of stock that we've had in our inventory for 1.5 to 2 years, and which of course today we had to sell at a book loss. So stripping that out, we would have been more or less around the zero mark, breaking even in the third quarter. In terms of the fourth quarter, we do see We do expect a strong finish. Typically, the fourth quarter is strong in the segment, and there's still a few weeks to go, but we are quite confident that we will see revenues that will be at least at the level and most likely higher than what we've recorded in the third quarter, with a positive effect on profitability in Q4. Good. And with this, I'm happy to hand over to Stanislav to walk you through the financial results.
Thank you, George. So let's go through the first slide. It's financial results. So as you can see on this slide, consolidated revenues reach 24.2 million in third quarter 2025, marking a 6.2% year-on-year increase. Revenues from electricity generation totaled euro 7.7 million, down by 13.8% year-on-year, following weaker capacity generation and slightly weaker average revenues. Other revenues increased by 19.3% year-on-year to euro 16.4 million in the third quarter 2025. The most significant growth was recorded in the technology trading business and the new energy division. Under other income, the group recorded proceeds from the sale of the Yandari project amounting to euro 3.6 million. The net impact of Yandari sale on EBITDA was 1.4 million euro in third quarter 2025. EBITDA of 4.4 million euro in third quarter 2025 compared to 3.8 million euros in third quarter 2024, up by 18.1% year-on-year, thanks to a positive impact of Yandari project sale. Below EBITDA, the group recognized an impairment charge in the 1.6 million euro. This impairment relates primarily to the write-off intangible assets in amount of 1.2 million euros associated with the software development for the new energy division, and additional euro 1.4 million. 0.4 million impairment related to the write-off the projects from the development pipeline. Financial expenses amounted of the 2.2 million euros in third quarter 2025, representing a 20.2% decline year-on-year related to the underwriting of a hedging position in Hungary. The total comprehensive income came at euro -2.2 million in third quarter 2025 compared to a positive euro roughly 1 million in third quarter 2024. Now I'm going to focus to the balance sheet. As you can see, fixed assets amounted to the euro 220 million compared to 216 million at the end of 2024. This increase of the assets can be primarily explained by the commissioning of the 5.1 megawatt peak in Hungary and the reevaluation of the Hungarian assets. Current assets declined to euro 48.1 million, down by approximately 7.8 million euros compared to the year-end of 2024 due to reduction in inventories by the euro 2.5 million. Other receivables by euro 5.4 million and assets held for sale by amount of 2 million euros. These trends were partially offset by high contracted assets by euro 1.4 million and high trade receivables by 3 million euro. Equity of 55 million euros and has declined by euro 4.9 million compared to the level recorded at year-end 2024 due to the negative result in this period. Adjusted equity ratio stood at 25.6%, excluding Hungarian and Romanian regulatory changes, and 24.2% without a carve-out effect. Long-term liabilities stood at euro 171 million, up to euro 3 million compared to year-end 2024. This increase was driven primarily by a reclassification of euro 5 million EBRD loan and increase of deferred tax liabilities up to year 1.6 million. Current liabilities amounted to roughly 41 million euros, down by 3.4 compared to year-end 2024. This is partly due to the above-mentioned requalification of EBRD loan back to long-term liabilities, which was partially offset by higher contracted liabilities by euro 2.3 million. Okay, cash flow now. Operating cash flow of 2.2 million compared to euro 6.8 million. Weaker operating cash flow can be partially attributed to the high non-cash items which were booked into the third quarter results. FX transaction difference and other non-cash items. Investment cash flow of euros -0.4 million as net difference between the acquisition of assets in the amount of 1.2 euros and the proceed from the sale of a Yandari project in the amount of 0.8 million. Financial cash flow of 1.9 million euros related to interest cost payment, while outstanding amount of debt remained stable. Net cash position decreased to euro 3.7 million. It's all about the cash flow, and the last is guidance to 2025. So in the first 9 months of 2025, the reported consolidated revenues amounted to 72 million euros, which represents about 72% of the lower end of the guidance range. In the same period, EBITDA amounted to the 8.5 million euros, approximately 94% of the right level. Upon the publication of the third quarter 2025 results, management maintains its view that the forecast EBITDA at the lower end of the revenue range remained achievable, and at this stage see no basis for revising the full year guidance. That's it.
Thank you. So this concludes our formal presentation, and so we are open to your questions, and we will. So while you use the chat box to type your questions, we have received some questions beforehand. So I will start with those, and we'll then address. We will address those that are coming through the chat box afterwards. So the first question is, how exactly will the group's liquidity situation be stabilized in the short to medium term? So, I mean, as you can see for the numbers, liquidity, of course, has been an issue for us, and the action that we are taking is at multiple levels. So one is the sale of assets that for us are non-core and non-strategic, and that mostly relates to some of our development projects. I've seen the first question in the chat box relates to the Domanowo project in Poland, a 20.4 megawatt project, which we are in the process of selling to Uniper, and this project has reached the ready-to-build stage, and we are currently in the closing process with the buyer. The net impact of the sale to our EBITDA is in the fourth quarter is going to be somewhere in the region of 600,000 to 700,000 euros, because of the delay of the project, of getting the project to the ready-to-build stage, which are due to the complexities of developing a PV project, or essentially any project in Poland. We have had higher costs, but we also had to reflect the development of prices in the market for PV projects in the Polish market, so that also the revenues have been adjusted downwards. So it is on one end a success that we got it to the final stage, but the economics are somewhat worse than what we were anticipating. But the important thing is we got it across the line, and we are in the process of closing this disposal. But of course, this is only one aspect, one of the projects. The other one that we have already spoken about before is the plan to dispose of our project Ciupaceni in Romania. So here we are at a very advanced stage of negotiations with a potential buyer, and at this stage, we expect to sign a sale agreement before the end of this year. The closing of that is targeted for the end of the first quarter next year, partially because some permits still need to be updated, and secondly, in Romania, this transaction will be subject to regulatory approval, which takes about 2 months. But of course, this is only one side of the action taken. We are also taking a very, very close look at all our business lines and trying to cut costs and streamline our operations as much as possible. So they're looking at, this is a tiny forward-looking statement, by the end of this year, I think you'll see that the headcount of the group will have gone down somewhere between 10 and 15% compared to the beginning of the year. So we're trying to take costs out where we see that the impact on our revenues or the potential to grow our business is the lowest. And so headcount is one area, but of course there are other areas and other cost categories that we are taking a very, very close look at. And so definitely for 2026, and for our outlook, it's important that first we want to grow in the business lines we have, and that of course is not only related to energy, but and here I would maybe go to the second question that we received beforehand, which is what specific reasons do you see for the possibility of a turnaround? So while we see growth opportunities in the energy segment, we believe very strongly that we have now reached a stage in our water business, and in particular in relation to PFAS and PFAS technologies that we have developed and continue developing to grow the business in 2026 and beyond in a way that will become a material contributor to our revenue, but also profitability. And here, one important element is that our in situ non-remediation technology, which can be applied to PFAS successfully, has been we've received patents for that technology in China and Japan, and we've also been notified that we will receive the patent in Europe. Still waiting for a response from patent offices in the other jurisdictions where we applied. And we've also made significant improvements in relation to our filter technology to remove PFAS. I think we spoke before already about the implementation of a PFAS filtration unit with an industrial customer in the Czech Republic at the beginning of this year. So that system works perfectly. The same customer actually has ordered for another PFAS issue. They have a second container, and we are also further improving the capabilities of this filtration unit. And but at this point, all I would like to say is that there may be some public news coming shortly on what we're able to do with our filtration unit. So we see a lot of potential and also the right conditions to grow this business very, very dynamically. The next question, how we intend to prevent the equity ratio from falling below the covenant threshold, which would trigger a right of termination for the bond. Of course, a key question. Here, of course, it is important to point out that, and in the ratio that we published, you can also see it, we have in the covenant a carve out to adjust for the impact of regulatory changes on our business, and these situations have materialized both in Hungary to a lesser extent and to a more severe extent in Romania. So adjusting for the impact, and the impact is double, we have generated fewer revenues this year, but it of course also has an impact on the value of on the carrying value of our portfolio in that given country. So adding that back, we are still above the 25% threshold. However, of course, we are uncomfortably close, and we are so there are several. First of all, we're trying to, of course, get the best possible fourth quarter in our operating businesses. We will have a positive impact from the Domanovo transaction. We, as I said before, expect to sign one other disposal before the end of the quarter, which would also have a positive impact. But we're also looking at some other measures to, well, another important area is, of course, the valuation of our assets, the carrying value, which is established on the basis of a discounted cash flow, where, of course, the interest rate level and the energy price futures play an important role. Here, we have seen a downward trend in interest rates, which have a positive impact on the discount rate. But we also see a strong outlook for next year and beyond for energy prices. So we believe that there may be a positive impact from the valuation of our power plants, but we're also looking at some other options, which at this point we cannot be more specific on. Needless to say, we are fully aware that this equity ratio is a key metric. We understand what the consequences would be if we fall short of staying within the conditions of the covenant, and the management attention is directed at making sure this is not going to materialize. The next question relates to our dividend payout policy, and where we have been consistent in communicating that we do not plan to pay our dividends in the medium term. So here the question by the investors, what the definition of medium term is. Well, I think it's obvious that at this point in time, paying out dividend is not really possible. First of all, based on our financial results, also the covenant that we have in our bond, and at this point in time, we need to redirect all the cash that we generate from our operating business and the disposal of non-core assets to build our business. And if some money is left, and at this point in time, we would definitely use it to reduce our leverage. And here I get to the last question we received beforehand, which is how we plan to refinance our bonds, and whether we are planning to repurchase bonds in the market. So that relates to the last statement I made. To that, any free cash would be used to reduce our financial leverage, and clearly, given current market prices, repurchasing bonds is the best option to do so. As those who are following us know, we have done so over the last 24 months. We have bought back around 1 million of nominal, and when the cash situation allows it, we will of course continue doing so. And of course, the purchase and retirement of our bonds also at below par also has a positive impact initially on our financial result, and then of course also directly on our equity, and it reduces our interest payments going forward. So depending on the liquidity situation, this is of course on our cards, and we will execute on that. And in relation to the first part of the question, which is how we plan to refinance our bonds, well, the first part of that strategy is for sure to have a significantly better financial performance in 2026. Then continue with that trend for 2027, and we will start, let's say, a more formal and more focused process on deep diving on the options that we have across public, private markets, but also, of course, bank financing after the audit of the 2025 results of the group. So actually, this weekend is exactly, it will be exactly essentially 2 years away from maturity, which is and is not a lot of time. So we understand everything will take time to organize, but the most important thing now is to improve the financial position and financial performance of the company, and of course, not just a little bit, but drastically. So all efforts are now focused on laying the foundations for an excellent 2026. I will now address the questions that came from you through the chatbot. So the first question related to the capital gain or the positive impact of the sale of the Domanova project, which I think I answered already. The second question is, why did the need arise to write down new energy software? Well, in our business, we are using a lot of softwares, and a lot of that has been developed in-house. And some of these applications are targeted at specific aspects of our business, and not all of them are fully functional. So when we see that there's a better solution, or not, when I say fully functional, when we find that there are softwares that are better, that have been developed externally, we sometimes decide to switch, and then of course we have to write off those capitalized development costs. So we have done a deep dive during this year on all the development projects that we've had. And sometimes, of course, it also comes from the discontinuation of some development work. So we have what I would call, and we're talking about tens of projects that are separately tracked, that have their budgets, have the targets, and I think it's not completely uncommon in software development that not all the efforts work out. So we have done a very detailed deep dive on this during this year, and have essentially what I would refer to as cleaned house, and made sure that we only carry, and of course our auditors would force us anyway, but we have done this exercise very thoroughly this year to identify those softwares that we will continue carrying on our balance sheet, and which need to be written down. So it is, of course, a relatively significant number. It is a one-off. We don't, at this point in time, we don't expect any further need to write off additional software at the end of the year. And we just basically make sure that we are essentially compliant with the rules and the logic of carrying capitalized intangibles on the balance sheet. Well, the next question is that we have reached the covenant before the carve-out. How will we address that? Well, so before the carve-out, or the effect of the carve-out, that is correct. And well, I think I would repeat myself. So first of all, we expect operationally a good fourth quarter. We have for sure one most likely 2 transactions, and the second one, which would be Ciuperceni, would have a more significant impact than Domanovo on our financial results. There, most likely it will be a capital gain and not contribute to EBITDA, but of course have the same effect on our equity position. Of course, buying back some of our bonds is also an option that we are evaluating, and if that's possible, then we will do that. And then, as I said before, there are some other options that we are evaluating, but we cannot disclose at this point in time. The next question is, what is your liquid assets, financial or hard assets? How easily can they be materialized? So what we refer to as liquid assets are cash or their equivalents. So these are, I think when you look at our balance sheet, what you will see is that we have available cash and then also restricted cash. Restricted cash is essentially all of it, or most of it is so we have about 1 million euros as collateral for bank guarantees, but the rest is our reserve accounts that we have set up and filled as part of our project financing, and over time we are able to unlock some of that, which is actually what happened in the transaction with K&H Bank. The financing that happened in the third quarter, where out of the 5 million cash proceeds, 750,000 were actually the unblocking of a reserve account. So when you look at the cash position, it's much bigger. But so restricted cash, of course, is what it means. It's what it says, but all the rest is essentially holdings in financial institutions. So the money on the accounts, and therefore available. The next question is whether the impairment of intangibles indicate the potential decline of the new energy segment as such, and potentially implies write-off of other intangibles, including goodwill. Well, in the audit, we just as we have done since we acquired Lerta, of course, every year there is one of the key discussion points with auditors is impairment testing of intangibles, which partially relates to our portfolio of generating power plants, but of course also the goodwill that has arisen from the acquisition of Lerta. So, and here an important element is the value of the business based on its opportunities going forward. And at this point in time, we feel confident that we will be able to sustain and, if you wish, defend the valuation and the goodwill that relates to the acquisition of Lerta. So the impairment as such relates to software, and as I mentioned before, so it's an impairment within the business division, and we have tried very hard to adhere to the guiding principles that any software or any project that has not been completed, and for example, it doesn't make sense to complete, or there are better options available either in-house or so. Even if we replace a software with a new or different software, the old one needs to be impaired. And in some cases, of course, as the market develops, sometimes external software is better than what we have developed, let's say 2 or 3 years ago. And if it's not amortized yet, then it needs to be written off. So this is what we did, and I think we did it thoroughly. The next question is what is our minimum liquidity level to operate? Well, it is probably a slightly different question to answer. I assume it probably relates to the cash level that is in the cash flow statement in our presentation. Well, I would put this way, of course, a cash balance that would be twice as high would be a lot more comfortable. So, and the disposal of the projects that we mentioned, and actually what we have not referred to yet in terms of cash in, we're still working on the refinancing of our 5 Romanian power plants. And linked to that, also the project financing of another 42 megawatts that we have ready to build in the Romanian market. And this is something we also working hard towards to close still before the end of the fourth quarter. So that will also, there we have a lot of own funds trapped or tied up, and we expect, so as things stand today, with that refinancing of the approximately 20 megawatts of operating plants in Romania, we expect to be able to repay external financing that relates to that, and we expect to generate about 3.5 million euros of free cash usable for our general purposes. And that alone should get us to the point that I was referring to before, about double the level of the cash that you have seen in the presentation. So the next question is, current trade payables significantly exceed current trade receivables. Considering also regular bank loans, repayments, and low balance of cash and lower revenues, how do you want to repay all the upcoming short-term liabilities? Well, we are, our businesses are, some of them are, most of them are generating cash. Firstly, secondly, we expect some cash from the refinancing. I was just referring to the sale of projects. So it is a situation that is definitely more complicated than in the past. But at this point in time, we are confident that well, we have been able to manage, and that we will continue to manage the working capital management of our group across all business lines. The next question is, should we be buying bonds from the market since their price is so low? Well, I don't think that we are, it's a good idea for us to provide investment advice. So this question we cannot answer. The next question is the current share valuation correct? It is very low. Yes, we are of course aware of it. As probably aware, I'm a significant shareholder in the company, and therefore absolutely motivated to make sure that this picture changes as quickly as possible. So the next question is that if we wrote off 1.6 million euros from intangibles, and the balance of intangibles on the end of Q3 compared to the end of 2024 has not changed that much, what else is included in that? Have you activated anything else which compensated the write-off? So the short answer to this is yes. Of course, we continue developing and upgrading the systems we're using, mostly in the new energy division. So yes, we continue spending on the development of software that we use in our business. One area, for example, is the software, but also the systems required to provide ancillary services to the TSOs. And here we're working on this simultaneously in Poland, in the Czech Republic, and Hungary. So there, for example, we have to establish physical connections, server connections, and that is actually also included in what we capitalize, and then amortize over time as we use the software. In the case where we discontinue using the software, we write it off. So yes, that write-off has been more or less compensated by further capitalized development of software / solutions. The next question is, what is the current status of the project in South Africa? And here, what we can say is that we continue developing the project. We have commenced the EIA process, and we are currently fine-tuning the final setup of the project. I think what we can say at this point is that it will also include traditional PV and battery systems, and we're currently fine-tuning the final setup so that we can also update our grid connection conditions with the DSO and proceed with the development and to get it ready to build. So I guess here we will, at the appropriate time, then make an official announcement or update you either through our monthly reports or the quarterly reports. So the project is progressing, and we still work on the assumption that the project will be ready to build next year, and so it means obtain all permits. I think we have clearly stated in the past that this is a project that where the lead role in executing it will be someone else. We see our role here as that of a developer, and we expect to basically make money on this project from the sale of this project to a final investor. The next question is, well, it's more like a wish that please remember that many people have invested and believe that the company will eventually overcome the impasse. Well, I see that as a wish of support for that, which I thank, and all I can say is that I'm highly motivated to do exactly that, and I believe that over the last 6 to 9 months we've put a lot of thought into how to reorganize ourselves, refocus, streamline processes. So that is something ongoing. As I mentioned at the beginning, we have looked into many areas where to cut costs, and of course it's an ongoing and never-ending process. And that is something. So we are really putting a lot of effort into being ready for a much stronger 2026. The next question is, after the sale of Yadnarie, what is the support for valuation of the RayGen investment in the balance sheet? Well, here it is important to point out, actually I'm very happy that this question was asked in this form. Our investment in RayGen as a company, and also the option agreement we have for bringing additional projects in the future, is unrelated to the or loosely related to the project that we developed in Yadnarie and have sold to AGL, which is also a shareholder. So in RayGen itself, our shareholding is currently slightly above 5%. Much bigger or larger investors, both in terms of their shareholding in the company, but also their own size. After the last financing round, the most important investor is SLB, formerly known as Schlumberger, so the oil and gas services firm, which has also entered into a strategic technology development agreement with RayGen, and is looking at making the system more efficient, but also focusing on finding new applications to the technology. So what we have been developing in Yadnarie, or in South Africa, and what we've mostly been talking about is essentially the full scale of a utility scale RayGen plant, which has the generation part and the storage part. but there are potential applications only for the development part. So we know that there are projects being developed which focus on only capturing the heat, of course, producing electricity, but capturing the heat from the modules and using that, supplying that to an industrial off-taker, or even using the heat to generate cold and cool data centers. One further not specified project, so which of course then only uses one part of the overall package that RayGen has developed, so it does not include the storage part. And from our point of view, so we are an investor in the company, definitely not the most important one at this point. So SLB and AGL as the investor into the RayGen plant, of course, now are much more important for the further development of RayGen. On the other hand, the Yadnarie project has been or is extremely important for RayGen as a company, because it is much bigger than the pilot plant that was commissioned in Carwarp. And it also shows that a major energy producer, the AGL is the largest energy producer in Australia, is willing to invest into this asset because they are convinced that the advantages of this technical setup are worth the investment. So I would say for what you would otherwise call bankability, or the Yadnarie project has definitely been or is extremely important for RayGen as a company. Our role going forward can and will be to identify suitable locations, find permits, obviously go through the permitting process, and create projects that will be using the RayGen technology, which then again will help RayGen in commercializing its technology. Of course, we're not the only developer that is trying to develop projects for the RayGen technology. RayGen has, I would say, its sights on projects across the world, working with different partners, also in very close cooperation with some of its key shareholders. So I think what we've done is with Yadnarie, we have provided an important anchor project for the next stage of development. Going forward, we will probably bring more projects to the table, but there'll be hopefully many more, which then should underpin the value of our investment in RayGen. But these are, again, two separate things. Therefore, the value of our investment in RayGen is loosely linked to Yadnarie, because it's an important milestone. But longer term, it will be a function of how many Yadnarie type projects there will be in the world that will be using the RayGen technology. And we will try to contribute to that, but others will have to do so as well. The next question is whether we have considered using Chinese suppliers for our projects to reduce capex, also in terms of transformers, switchgears, BESS, power generation equipment. If so, what is your experience? Well, I think since we have started our business 18 years ago, we have not used any, in our own projects, not used any non-Chinese modules. So even back then already, Chinese were dominating well, there maybe have been some Taiwanese, but essentially already at that time, module manufacturing in Europe was insignificant. What has changed since then is that the Chinese have also become dominant in inverters. So we still remember a time when SMA was the gold standard. Now it's a small, comparatively small, struggling competitor to Huawei and Sungrow and some of the other names. And I think the same applies to batteries. So I would say for these three categories, there is essentially no alternative, no viable alternative to Chinese products. With switchgear and transformers, it is a different story. There we have so far relied on European producers. And we're talking about the whole transformers, the whole switchgear, of course, components, I'm sure, have been coming from China for a while now. So what we do see, and I think it's a matter of the last year or two, that some of these Chinese manufacturers are also now trying to gain, I would say for now, market share. I don't want to say gain control, but gain market share in relation to transformers and switchgear. And here, here it becomes a lot more sensitive because modules and inverters and batteries are more or less standardized products. But transformers and switchgear have to be compliant with local regulations. As we are building in several countries, those regulations, even if they're all EU members, they differ. And of course, so transformers and switchgear are not necessarily the same type of commodity product as modules, batteries, and inverters are. So here we definitely take a cautious approach. I mean, we do see that the offers we're getting are below what we would have to pay from a local supplier. But here that's an area we just cannot make a mistake. You cannot, I mean, ordering a transformer that is not compliant, and then you have to order another one or have that redone, can cause a lot of damage. And if only it delays, for example, the commissioning of a power plant, and whether it's ours or that of a client, and that leads to contractual penalties, almost doesn't matter. So in other words, just to save, I don't know, 10%, 15% on a transformer, well, we have to be 100% sure that equipment is usable and compliant and will not lead to these kind of troubles, where then the consequences are a huge multiple of what we expected to save. So I hope that was a good answer to that question. And let's see whether there's... Well, I believe that this was the last question. Oh, the last question, what are the financial effects of the Photon project for the company? So, well, I think in our in the quarter report, you see we've made a description. In short, it has been below our expectations. So we have had cost overruns. So the margin, the gross margin on the project was materially lower than what we expected. And unfortunately, we have incurred a delay, which led to liquidated damages, so that overall the project has been loss-making for us. So a rather painful experience. I would say a relatively long list of lessons learned, some of them related to how the project has been managed. In the light of this project has been executed in a market that is still at the very beginning. So we have also signed up to provide O&M services to this power plant for the next 2 years. And New Zealand, the Photon project is, I think, the 4th or the 5th utility scale PV plant in the country. Now a lot more is getting built. The pipelines are quite significant. But it also means that the whole ecosystem in New Zealand is still on a relatively steep learning curve. I mean, in some cases, I would say know-how could be imported from Australia, which of course is a mature solar market. But for the DSOs, it was for the first time, and some of the equipment manufacturers. So some of the cost overruns and delays are also attributable to the fact that the whole market is still learning, and in a perfect world you have cost and time buffers to absorb that, which essentially we ran out of on the specific project. The next question is how the company is going to address the green bond issue in 2 years from now. So, well, I think I addressed it already, but I'm happy to repeat. So the number one priority short term is to set the stage, and that's what we're working on, set the stage for a significantly improved performance next year. That includes cost savings, some of them HR, but also other types of costs, a strong focus on winning more business, executing the business, also in business lines that so far have not been that active, and that can bring a lot more to the table. That includes water and remediation, which will play a more significant role next year. There's definitely more business we will be able to do in EPC, whether there's utility scale or behind the meter. Doesn't matter. We hope for growth from those areas. Operations and maintenance is a business that that as it grows will start performing very strongly, because the operating leverage in this business is very strong. And I also mentioned that we have a completely new category of assets to take care of in the form of battery systems. And so improving business and financial performance is the basis. And we will, once we will have passed the audit and published our audit results, the due date for that is the 30th of April next year. We will deep dive on our options and strategic possibilities to refinance the bond and develop I would say, multi-pronged strategy, which we'll start executing on. And that will cover, as I mentioned before, bank financing, capital markets. Of course, with our current bond price performance, the bond market, at least in Germany, will be rather difficult. But we believe that there are multiple pathways available, and we will start working on developing a clear strategy. And I think as we make progress in this, we will also make the corresponding announcements to the market. The next question is whether the impact of O&M on finance right now is negligible or neglectable. How much it would have to rise to have a meaningful impact on the finances? Well, yes and no. I mean, O&M, and let's not forget, we're also now adding asset management services, is a business that has high operating leverage. That means, you have certain systems, you have a number of technicians, which of course as you take on more assets, you keep growing. But the marginal profitability of new assets you take under management is actually going up. And asset management, which is a relatively new service for us, is actually particularly lucrative because it's an office job. And they're also leveraging the experience we've gained from managing our own assets in the various countries. So it is a business that, as it grows, we expect its profitability to go up dramatically. At the moment, our strongest market is Hungary, both in terms of megawatts under management and also profitability. And if you had asked me this question a year or two ago, I would have said the target achievable margin for our own O&M division is about 20%, maybe 25% EBITDA margin. But we've seen in Hungary that it's possible to do more if in the right set of circumstances. So I believe that there's a lot of runway for us still to grow this business strongly in the 5 countries that we're focusing on. And of course, I would not exclude that at some point in time we would add other countries, whether there would be let's call it a westward move to maybe address the German market, which of course is very mature. There's a huge installed capacity, but also quite a lot of competition, or an expansion into one of the neighboring markets in Southern Eastern Europe. And this is just an example. I mean, for example, Bulgaria is a market where a lot gets built. It's right next to Romania. So such an expansion is definitely something that if we had, for example, an interested existing client who would ask us to take care of their assets there, it's definitely something we would very strongly consider, and then use it as a basis to win additional clients and business in that country. What we'll not do is just go to any market because it looks like a good idea. It's nice to have a flag there, but it's not the customer base that we have built and continue building in the region as the only regional O&M player is, I think, quite impressive. So it is literally the household names of institutional investors and IPPs that invest into the region from outside. Of course, you also have local customers, but I would say it's the who's who that invest in the region. And with some of these customers, we take care of assets in 2 or even 3 countries now. So they really seem to like the fact that there's one telephone number they call with the same contact persons to discuss their Polish, Hungarian, and Romanian assets. And I think that still has a lot of runway to go. And as I said, I would not exclude that we would follow the call of one of those investors into a new geography that is not too far away. And to conclude my answer, I firmly believe that going forward it will have a much more significant impact on our revenues, but mostly also EBITDA than what we've seen so far. Next question is that the number of projects under development seems to get smaller and smaller. Can you elaborate on that? Is there no more opportunities in investment for now, or is this caused by not enough capital to engage? It's actually both. Clearly, we have been investing quite strongly into developing projects in the past. But I think it's important to bear in mind that things have changed very fundamentally. And the economics of a PV plant and the project is just the kind of the stage before is different than what it was before. There's essentially, with a few exceptions, there are no more support schemes. So any major renewable energy project, and it's not only PV, but can be wind, can be biogas, today has to rely on the market price of electricity, which of course can come in the form of a power purchase agreement, but definitely the revenue model is linked to the market price. And given where market prices are today, the margins are slim. I mean, investment costs on PV have come down a lot, but you have to be really to get to the return levels that you need. You have to know what you're doing and understand also the energy markets, which I think overall we do. But even then, the kind of exit returns of about our cost of capital or the cost of capital at the project level is very hard to do. And then the question is it actually worth the effort? Is it worth the risk? And when you develop projects, of course, you have also time delays. Some projects may not work out, so you have write-offs. And here, I think our approach that we focus more on providing services to other people's assets at any stage of the lifetime, and that would include EPC, that would include O&M, that would include asset management, offtake, is ultimately a lower risk and significantly less capital-intensive strategy. As I mentioned before, we still have 42 megawatts that we want to build in Romania, for which we hope to close the project financing. But I would say our appetite, and to some extent it is driven by our limitations, but also sensibly our appetite for developing PV, but even hybrid projects is somewhat limited in Europe. We are, of course, developing the big project in South Africa. It is a country that has a lot of irradiation. It has a shortage of energy, relatively high energy prices. So essentially all the hallmarks and all the ingredients that company like ourselves would like to see. And also now we see that there are more investors coming into the market. The banks are ready to finance projects even on a relatively long-term basis, and the numbers simply stack up. So I would say from that point of view, and developing projects is a lot cheaper than here in Europe. So which does not mean that we're now going to enter 15 more countries and trying to do the same, but South Africa, where we have now been on the ground for 2.5, almost 3 years now, is definitely a market where we will try to leverage our experience, including project development, and try to create value. But coming back to Europe and particularly the CE region, developing projects has become very painful. So it's something that I think we should not focus our attention on, and I think that's where the pivot to put ourselves in a position to provide a long list of services to investors that do create assets has been the right one. Clearly, we still need to improve the execution of that strategy. And as I said, this is currently our main focus. So with no more questions coming in, I would like to thank you for your attention and wish you a great day. And we will see you again in the second half of February when we'll be presenting our Q4 and full year unaudited numbers. So thank you very much and have a great day. Thank you. Bye-bye.